1 2. Check 1 2. Check check. Check check 1 2. Mic check. Mic check. Check. No. Check 1 2.
will be beginning shortly. For those who haven't yet had your breakfast, please make sure to do it now. On your tables, you will find folders that have registration forms. Please make sure that you fill those out, and we'll be around to pick them as soon as we've started. Thank you very much, and please enjoy your breakfast. Okay, good morning once again, ladies and gentlemen. I know it's a very Ugandan thing to do, but I know you've had breakfast, so I'll expect a bit more robust response. Good morning, ladies and gentlemen. Much better. My name is Ralph Akorabirungi from the Communications Department in the Bank of Uganda, and I'll be your MC for today. So without any further ado, so we can make up for the time, let me please invite Ms. Prosi Namala, also from the Central Bank, to lead us in an opening prayer, and then we'll be ready to begin. Thank you.
Thank you. Let's humble ourselves and have a short prayer. Lord, we want to thank you for this day. We believe this is the day you've made. We make so that we can make good deliberations for the good of this country and to serve your people more. We praise you that every deliberation that is going to be made here, it's going to be for the glorification of your name and to uplift our country for the glory of your holy name. We pray for the speakers and everyone is going to share in this discussion, that there will be clarity in each and everything that is going to be said, and it will be for the glory of your holy name. In Jesus' name I pray, amen.
Thank you very much, Prosi. Can we please give her a round of applause? So, ladies and gentlemen, you're all very welcome to this inaugural Financial Stability Symposium. Without preempting the director and the presenter's marks, I just want to remind you all to please continue to sanitize. There's lots of sanitizer on your tables. Please wear your masks as and when you can. And let's try and maintain as much social distancing as possible in the circumstances. So, ladies and gentlemen, please allow me to introduce Ms. Charity Mugumya, Director of Communications at the Central Bank, to give her opening remarks.
There we go. Can you hear me? Okay. Thank you, Ralph. The Executive Director, Supervision at the Bank of Uganda, directors and all BOU staff, our colleagues in the media, ladies and gentlemen. A very good morning to you all, and a warm welcome to the first Financial Stability Symposium hosted by Bank of Uganda here at the Golden Tulip Hotel. As Ralph had stated, my name is Charity Mugumya, Director Communications at the Bank of Uganda. Thank you all for honoring our invitation. Your presence today speaks to the value you place in us, as well as your interest in BOU activities. It is hard to imagine that over 2 decades ago, it was unlikely that a central bank would hold a conference stemming from the need to communicate more efficiently. We have come a long way from days when central banks were highly secretive institutions with rather ambiguous mandates. I'm also certain that central banks' communication departments, if they existed at all, were small establishments at the time. However, since the global financial crisis of 2007/8, increasing responsibilities have been placed on the shoulders of central banks, including the addition of financial stability to central bank mandates in many countries, Uganda inclusive. This has prompted central banks to continue communicating their expanding mandates so that the public is aware of what a central bank can do and what it cannot do. Indeed, at Bank of Uganda, a fully fledged financial stability department was established in 2009 to strengthen macroprudential supervision and contribute to the bank's mission of fostering price stability and a sound financial system. Dr. Twinemanzi Tumubweinee, Executive Director Supervision, and Mr. Robert Mbabazize, Director Financial Stability Department, will expound on financial stability and macroprudential supervision in their presentations. With the institution of the Financial Stability Department at Bank of Uganda, several measures were also put in place to ensure transparency by communicating on and about financial stability matters through the Financial Stability Report, Annual Supervision Report, Governors Meeting with Uganda Bankers Association, quarterly financial stability reviews, among others. We continue to applaud the late Professor Emmanuel Tumsime Mutebire for ensuring that Bank of Uganda set up measures that strengthened its accountability, transparency, and credibility. We pledge to continue upholding his legacy by maintaining the values that he treasured. Let us take a moment of silence to remember him. May he continue to rest in eternal peace. Financial stability has brought about challenges such as what to communicate, how to communicate, and how much to communicate. Certainly, communication on and about macroprudential policies should go beyond data, associated analysis, and derived measures, but focus more on getting the messages across and gaining support from stakeholders. It is for this reason that we are here today. The key objective of this Financial Stability Symposium is to increase awareness, understanding, and appreciation of Bank of Uganda's financial stability analysis and policy recommendations. Thus, today's event incorporates two activities, that is, the launch of the Annual Supervision Report and a presentation on the state of the financial sector. We acknowledge that the Financial Stability Symposium is a useful forum not only to express and impart our message, but also to engage and listen to the views of our stakeholders. We recognize the importance of knowing what you think about the bank and our policies. Events as this one are also important mechanisms for learning from one another and are critical for the evolution and dissemination of ideas and experiences about what works and what does not work. Similar to the inaugural Monetary Policy Forum that was held on February 15th, 2022, today's Financial Stability Symposium also focuses on the media as our primary target audience. This is because you, the media, I believe, have a multitude of topics to discuss, not just today, but even tomorrow. In addition, with the need for timely communication, the evolution of the financial sector, emergence of new digital communication channels, and the challenges that come with them, the media is very instrumental in determining the success of our communication. We therefore aim to empower the media through this Financial Stability Symposium so that going forward, first-hand and accurate messages on and about the stability of Uganda's financial sector can be disseminated through the various media channels. Thank you once again for taking the time to come and participate in this Financial Stability Symposium. It is now my honor to invite Dr. Twinemanzi Tumubweinee, Executive Director Supervision, to launch the Annual Supervision Report. I wish you all a fruitful engagement.
Good morning, everyone. My role here today is rather simple. It is to take you through the highlights, the key highlights of the annual supervision report for the year ending December 2021. I think let's start by saying, so what do we expect in the annual supervision report? In this report, what Bank of Uganda does or is going to do is bring to or highlight to you, for your attention key issues and matters that were seen, observed during the year January to December 2021. So, in my presentation today, it's going to be rather brief. I'm going to focus on 4 areas. 1, naturally, like the report says, talk about the supervision of financial institutions. 2, I'll then highlight a few key sector developments within the financial sector. 3, I'll touch briefly on the financial stability assessment for the period ending December 2021. And lastly, I will also touch upon the progress we've made in terms of complying with the Basel II. Supervision of financial institutions. I think the first thing I think we need to bring to all of us to understand in this room is when we say Bank of Uganda is responsible for supervising financial institutions, what exactly do we mean? I have listed out the kind of institutions that we regulate: the commercial banks, credit institutions, forex bureaus, payment service providers, payment system operators, e-money issuers. But I think I would just like to draw my attention, or just draw your attention, to what we understand as what our supervisory process is. So in the supervision process, there are 2 aspects that we focus on. There's what's called on-site examination and off-site surveillance. On-site is where Bank of Uganda sends in teams to the various institutions to conduct checks on the conduct, the practices, and the operations of these regulated entities. Off-site surveillance, the regulated entities submit reports or certain data which we review and make an assessment. So the way the supervisory process works is that on the basis of our off-site surveillance, on the data they submit, we make an assessment, and that determines what kind of questions we should be asking when we go on-site. So there's an interconnection between off-site and on-site, in the sense that findings on off-site are what determine what we do when we go on-site. And in the conduct of this supervision, there are a number of ways we do it. 1, naturally because of COVID, some of these interactions are virtual, online. Others require face-to-face or person-to-person engagements. But I'd like to draw your attention to something we call probability and impact rating system. In other words, the conduct of the conduct and the practices or the operations of a regulated entity are assessed on 2 dimensions. Remember, Bank of Uganda focuses on risk-based supervision. So we look at the probability of a risk occurring and the impact if that risk was to materialize, what would be the impact of that risk? So think of it as a 2-dimensional space. On one side, you have the impact, the probability of occurrence, and on the other side, you have the impact of that risk materializing. Then we also conduct what are called targeted reviews. So oftentimes in the course of normal business as a supervisor, there is sometimes a need to go in and interact with a regulated entity on a specific, very specific matter. We call them targeted reviews. It might be on governance, it might be on the operational risk, it might be on their strategy, it might be on their liquidity, it might be on their capital. There are a whole range of risks or areas for which we conduct what are called targeted reviews. Okay? And then lastly, in the normal course of business, we also have what are called ad hoc meetings. In other words, where we either invite the management or the board or the shareholders of these regulated entities and have conversations about areas of supervisory concern or that we think might be of concern going down the road. So in a risk-based assessment, it is not about waiting for risks to materialize, but we try and conduct the supervisory process in a manner, what can only be referred to as an anticipatory manner. If we expect that something is going to cause a problem down the road, we have a conversation in the ad hoc meetings with the supervised entities to address it. If it's not addressed in a manner or in a timely manner that we would like, we then conduct a targeted review and then issue what are called corrective actions. That we have seen something wrong, you need to correct it. They are what are called prompt corrective actions, and then the regular corrective actions. And depending on the supervised entity's response, then the law provides us with the means to either enforce or ensure compliance with some of those corrective actions. Just to give you a synopsis, during the year ending December, and this is in the report, we did conduct a number of on-site examinations. Again, just to remind you, the choice of the institution and the number of inspections is informed by its placing on the probability and impact rating system that we use as Bank of Uganda. So if an institution, based on our peers' assessment, is high risk, then we conduct more regular examinations. If it's medium risk, slightly fewer. If it's low risk, even fewer times do we interact with that institution. So just as an overview, in the period ending December 2021, we have 26 commercial banks. We only conducted 12 on-site inspections. Out of 4 credit institutions, we conducted 3. That will then immediately now tell you that perhaps there are more high-risk credit institutions than there are commercial banks. Because if you see the commercial banks, it's about 50%. While for the credit institution, it's about 75%. For microfinance deposit-taking institutions, it's about 50% too, 2 out of 4. For the forex bureaus and money remittance, we conducted 46 on-site inspections. Sector developments. A key one, which I believe garnered a bit of press last year when we made the announcement, was the increase in the minimum paid-up capital for all regulated financial institutions. The rationale then, as we stated, and I will repeat today, was that the amount of capital a financial institution holds represents the amount of risk it can take on, and therefore the amount of the rate at which it can grow its balance sheet. Second, we also put in place capital buffers and leverage ratios, which kicked in, I believe, on the 31st of December 2021. Third, Bank of Uganda, during the course of last year, established 2 unique units, one focused on anti-money laundering, and the second one on resolution, financial institution resolution. I'll just talk a bit about the resolution unit. If you will recall, in 2018, 2019, when Bank of Uganda was interacting with the COSASE Committee of Parliament on the way we had closed and managed the closure of banks in the past, it was brought to our attention, and we did admit that perhaps it was time to have a unit or section at Bank of Uganda focused solely on ensuring that the process of taking over, managing and disposing of the assets of a closed institution or a failed institution is managed in a very systematic way. Now the SFI, the resolution unit, won't just be doing just the business of liquidation. It will also be part of the risk process. In other words, in the sense that when we, like I said earlier on, when we issue corrective actions and the financial institution is not compliant, the resolution unit will then take over and be responsible for ensuring compliance and doing regular assessments to determine whether or not that institution should be allowed to continue operating or should be allowed to exit the market in an orderly manner. And I think the first success that we have seen recently was the recent voluntary liquidation of Afriland First Bank. That is what a true resolution unit does, that you manage the process of resolving financial institutions, because they are companies, they're first and foremost they're companies in the beginning before we give them a license and they become banks. But should they be subject to stress or face significant operational problems, there should be a mechanism, as there was at the time they entered, there should be a mechanism for their orderly exit. The other development was we are at the tail end now of reviewing and revising the Credit Reference Bureau regulations, which is going to expand the coverage from where information for the CRBs can be gotten. So outside of just financial institutions, the revised, in the new dispensation, credit reference bureaus are going to be able to get information both on financial and non-financial credit. When I say non-financial credit, I mean even trade credit. Those who provide trade credit are going to be required or are going to be allowed to provide information to the CRBs and similarly to get information from the CRBs. And then as for the mortgage refinance institutions, we are introducing a new aspect within the mortgage industry in Uganda, in the sense that we're putting in place a regulation that's going to enable for long-term financing of mortgages for Ugandans. That has never been clearly specified, but now with the regulations in place, it's going to mean that, one, instead of having the current environment where you have mortgages with a variable rate, these regulations are going to enable for the establishment of institutions that allow for and support fixed rate mortgages over a longer term. And then we've also had a change in license fees. This was long overdue and had not been done in more than almost 20 years. So the license fees that financial institutions are going to pay is going to partly offset the cost of ensuring and supervising them. The other developments, another welcome one, in December, I believe it was 9th December, Post Bank, which had been a Tier 2 institution, was finally approved to become a Tier 1. So Post Bank is now a fully fledged commercial bank. Another development, at the end of September, the credit relief measures that we had put in place in April 2020 officially came to an end. The only difference was we left them still available for the hospitality and the educational sector, and even those will be coming to an end in September this year. Another notable development was that I&M Bank, I&M Holdings, which is the parent company for I&M Bank, which is listed in the Kenya Nairobi Stock Exchange, concluded and took over, acquired 90% of Orient Bank. So now Orient Bank, if you have noticed now, does no longer exist. It's now I&M Bank. This particular transaction, if you allow me just talk about it a bit more, is notable in the sense that it is an affirmation, or it's an indication of confidence in our financial system for regional entities, regional listed entities deciding to enter our market even in the middle of the COVID period. Then we began implementation of Basel II. Now, Basel II is a series of supervisory guidances and accords that will continuously reflect changes in the world financial system, which become guidances for how financial institutions, one, are regulated, but two, how they conduct their business. And we expect that full implementation will be completed by June 2024. ECD stands for expected completion date. And lastly, in terms of sector developments, we are in advanced stages of reviewing a significant number of laws for the sector. The Financial Institutions Act of 2004, the Bank of Uganda Act of 2000, the Foreign Exchange Act of 2004, and the MDI Act of 2003. I want you to note one particular thing, that if you look at all these 4 laws, that have been guiding how we supervise the financial sector, they are on average 20 years old. And we know that banking has changed. Financial services sector has changed significantly over the last 2 decades. None of us in this room still interacts with their financial services provider today the same way they did 5 years ago or the same way they did 10 years ago. Unfortunately, the law that governs how we supervise the sector has not been catching up as fast. So that's one of the key developments in the last year was we've commenced and we're about to conclude the comprehensive review of these old laws to bring them up to date to where banking, to where financial services are today and how we use them. Now, for the financial stability assessment in the report. So banking sector resilience has continued to improve and did improve during the year ending December 2021. But it was supported by a number of developments therein. One, we noticed a gradual recovery in economic activity. We also observed the significant capital and liquidity buffers that the financial institutions were holding, mainly as a hedge against the COVID pandemic, but also because there was significant amount of uncertainty about how long it was going to last or even what the effects would be post the end of the crisis. 3, and also very important, is that a significant amount of this banking sector resilience, and I'm not here trying to blow the trumpet of Bank of Uganda, a significant amount of this resilience is a function of how effective and efficient the policy responses by Bank of Uganda were. Remember, we had a lockdown. It was announced, I believe, towards the end of March, and by the first day or second day of April, we had already put in place certain measures to ease the impact of that lockdown. When there were subsequent changes, we also kept on making our policy responses were quite timely in terms of, on average, spanning about a week at most from when there would be changes to or adjustments to the containment measures and our policy responses. 4, Bank of Uganda took on an accommodative monetary policy stance. If you will recall, during that period, we brought down the reference rate, the CBR, continuously to the low of 6.5%. It's only recently, I believe about 2 weeks ago, when we subsequently revised it upwards. Again, there were different reasons for that. So in a period where you have significant containment measures in place, we had a pandemic, there was limited economic activity, we put in place measures like the credit relief measures that I spoke about earlier on. We reduced the CBR. We put in all manner of regulatory accommodations to enable financial institutions and their clients work through and survive this period without necessarily causing too much stress to the customers or too much stress to the financial institutions themselves. However, like every economist, we always start on the one hand and on the other hand. On the other hand, under this financial stability assessment, there are still some downside risks. One is that much as there was a recovery, it was weaker than expected from a global perspective. And since we do not act in a vacuum and we act within the context of a wider global system, when you have weaker than expected demand or growth elsewhere, it tends to pass through and affect our ability to also achieve our own growth goals or growth targets. 2, towards the end of the year, 2021, and also we've now seen it in the first half of 2022, is that there was a high risk of capital flows or capital flow reversals or capital flow exits from the economy as interest rates were beginning to rise in advanced economies. 3, the inflationary pressure from structural impediments in the global supply chains. Remember, they had been disrupted by COVID, okay? Some of those impediments are yet to be completely resolved, so they're coming through but we are beginning to feel them through their impact on inflation, which had kind of started to notch upwards towards the end of the year and has since then been on an upward trajectory. And lastly, the downside to the financial sector's performance and stability, based on the assessment in the report, was also reinforced by geopolitical tensions. Geopolitical tensions, you know that at that time we were at the height of our differences with one of our neighboring states. We had countries like Kenya and Tanzania putting bans and restrictions on exports or imports to Uganda. And then subsequently since then, we've had other events and developments in, between Russia and Ukraine, all of which in summation tend to press downward pressure on any expected upward improvements that we were expected to see in the financial sector. I then put up a table in the report. We have a table of systemic risk assessment, and I'd just like to take you through it. Please note that this is as of end of December 2021. There have been some subsequent changes to these directions of risk since then. Overall risk for the whole financial sector is edging upwards, even though it's still marginal overall. But along the dimensions of different individual risks, and I'll talk about them here, for macro risk, for example, it's been more or less flat. Credit risk has edged up slightly. It's not yet in dangerous territory. If you look within the report, I believe there was less than a 40 basis point increase in the average NPLs across the whole year for the sector. Liquidity risk has more or less remained more or less constant. It's not yet in dangerous territory, so it's not yet red, but it's still elevated. And largely, the reason why we managed to maintain a flat line is when you look at all the various liquidity facilities Bank of Uganda put in place to help financial institutions or to ease liquidity stress within the financial system, is one of the reasons why liquidity risk, while still marginal, has at least more or less flatlined during the course of the year. Market risk, same thing. Operational risk, slightly edged upwards. Profitability and solvency remains good, but has not changed significantly if you look on year during the period. And then structural concentration risk in terms of either sectors or lenders or sort of borrowers remains marginal. At the end, I'll just show you where these arrows have now moved to as of the end of March. Now, progress on Basel II. In July 2021, we issued guidelines adjusting upwards the minimum requirements for capital for credit, market, and operational risk using a standardized approach. We have also issued guidance notes mandating the conduct of an internal capital adequacy assessment. Now, I'll just talk a bit briefly about the ICAP. The core concept behind an ICAP is that every institution, especially for the deposit-taking institutions, must be able to sit down, assess or analyze the kind of risks it faces in its operational environment, and then make a determination of how much capital they should be holding for each of those individual risks in the event the risk materializes. They come up with an estimated figure for capital and then compare that to the amount of capital they are holding. Remember, deposit-taking in financial institutions do not lend their own money. They lend depositors' money. But for you to be able to lend depositors money, you must demonstrate you're holding your own money. In the event that money is to be lost, you've lent out, you can restore it or compensate the depositors for putting their money at risk. Okay? I just want us to be very clear about that. So the amount of capital a financial institution holds, for example, determines how quickly or how much it can lend and how much risk or how much bad loans it can hold. Because when it lends your money to someone and that person is unable to pay or is having problems repaying the money, You don't want the depositors to go when they are going to withdraw their money from an ATM. Imagine going to an ATM to withdraw money and you see a message and say, we're waiting. Sorry, there's no money, we're waiting for some money from Twinemanzi. Okay? So the bank must have capital that if we lend the money, if we lend your money out, and the borrower is having a problem repaying it, we should be able to touch from our own capital, replace the depositor's money, and then follow up with the borrower, while you, the depositor, to you, your money is always safe. So the amount of deposit liabilities a bank can hold and the amount of credit or loans it can make, which is a reflection of its size and growth, is a function, is a direct function, is almost a one-to-one function with the amount of capital the bank holds. With regards, again, going back to Basel II, we've been conducting reviews of these ICAPs. We are also putting in place, we are documenting how we review the ICAPs through a process called the Supervisory Review and Evaluation Process that will govern how these reviews are conducted and how we shall assign capital add-ons based on how much risk these institutions are taking on. The next steps under Basel II require that we provide a guideline for Pillar 3 under Basel II, which is on market discipline. Just a bit on Pillar 3. Pillar 3 on market discipline is going to be more focused on disclosures of the financial institutions in terms of how much information they make available both to the regulator and to the public with regards to their conduct. This is about introducing transparency in financial system, the financial system. So, just to reiterate, that Bank of Uganda shall continue and remains committed to act with timely and decisive policy responses to emerging risks affecting financial system stability. Ladies and gentlemen, that's my presentation. But I just wanted to bring something to your attention here, and I thought to help you understand the business of financial stability and the business of Bank of Uganda from the perspective of a supervisor, I thought I would put up this table to help you understand how we assess risk and determine which institution to either conduct an examination on or not. I believe that's the y-axis. For those who remember their O-level mathematics, on the y-axis we have severity, which is impact of a risk. And there are 5 dimensions: no impact, minor, medium, major, extensive. On the x-axis, we have the probability of that risk materializing or happening. Again, highly unlikely, unlikely, possible, likely, very likely. Where a financial institution, and allow me just point at the screen, where a financial institution lies based on our own assessment determines how often we shall be conducting examinations. So if an institution in our assessment is in the top right corner, that means in terms of impact, it's extensive. In terms of likelihood of that risk, it's likely. That's an institution that is high risk, and we therefore, based from our risk-based supervisory approach, are required to go and interact with that institution much more often. If it's within the yellow boxes, we interact with them, but not that often. So currently, and the Director of Commercial Banking is here, currently the approach we use is that high-risk institutions, we have to come in and do full scope examinations at least once every 12 months. For those in yellow, it's once every 18 months. For those in green, it's once every 24 months. Now you might ask and say, but what happens in between? Just because we're coming in to do a full scope examination once every 24 months doesn't mean we stop observing you. Remember, like I said at the beginning, one of the key tools we have is off-site surveillance. So from the numbers that you report, we conduct our own analysis and determine whether your risk profile has changed. So while, say, at the end of Q1, you might be in yellow, nothing stops that by the end of Q2, you might have moved to red, and then we change your profile in terms of how often or how intrusive and how regular our examination shall be. The second thing I also wanted to bring to your attention was, remember the table I showed you about systemic risk as of end of December. I have now, in updating it with the data as of end of March, this is using quarterly data. Please note a couple of things. Notice now that liquidity risk, look there, is now coming down. So liquidity risk has become reduced. Why? Banks and financial institutions are largely holding significant amounts of liquidity. We have put in place all these liquidity measures for them. And we don't, from our assessment, we don't think there is significant liquidity risk. As of end of March, between March and now, that might be a different story. But as of end of March, there was not a significant risk from liquidity. Look at structural risk at the bottom. In the last table I showed you, it was flat. As of end of March, you see there's been a change. It's red and increasing. Because you see, while banking sector concentration was moderated, look at what happens to the share of the 5 domestically systemically important banks in terms of their impact in the market. So the 5 top banks, their size of the market has reduced from 60.3% to 57. That's a 300 basis point reduction. And yet, when you look at banks' exposure to the 5 largest borrowers, it has increased from 20% to 25%. Okay? So it's on that dimension alone, you see structural risk has increased. Even credit risk. Okay? Credit risk continues to edge, and if one was to hazard a guess, it is most likely that if we look at the numbers for end of June, and you imagine there was going to be a third column for the end of June, that credit risk will probably be a red arrow going upwards. Okay? So when you look at the approach that we use as Bank of Uganda on the assessment of risks, this is the analysis that goes, this is what informs our decision making, that we look at risks as they evaluate their probability of occurrence, the impact of those risks, and on the basis of that we make a decision on either how to respond within the overall market, or also more in particular, how we conduct our supervision of the banking sector. So ladies and gentlemen, I have no further questions. Thank you very much. And also I would like to formally say that the annual supervision report is now available on the Bank of Uganda website. Please feel free to access it, read it, and I think the information therein will help you understand a bit more in terms of what we do as the central bank within the broader mandate of financial system stability and supervision. Thank you very much.
Thank you very much, Twine. Again, ladies and gentlemen, can we give him a round of applause? You'll realize that he was very deliberate in taking his time to explain most of the acronyms that we have there, ICAP and some things like Basil. Some people behind there thought Basil was used for cooking, but I'm sure after this presentation, we're on the right track. Ladies and gentlemen, and those following us online, please note that as Dr. Twine said, the annual supervision report has been released. It is on our website, www.bou.or.ug. Please download and read through the annual supervision report. Those following us online, you can also send your questions to our team, and we shall have people here answer. Without any further ado, please allow me to call Mr. Mbabazize to come and give a presentation on the annual supervision report. Thank you. Only problem
Thank you, Ralph, and good morning, ladies and gentlemen. Good morning. That's much better. So I'm going to make a very short and precise presentation on the financial stability assessment as at June. In terms of the outline, I will start with some preliminaries, especially on what financial stability assessment means. And then we shall look at the coverage of the risks that we assess when we look at financial stability. And then we conclude. Now, Dr. Twinemanzi in his presentation touched on the issues highlighted on this slide. But our communications team requested that we provide some preliminaries in terms of what does financial stability mean and why do we do it. The policy of Bank of Uganda with regard to regulation of the financial sector, if I could summarize it, is aimed at ensuring that we have a financial system that is sound and can continue to operate even in the worst circumstances, even when the worst risks materialize, that the financial system continues to undertake its key responsibilities without any disruption. And to use an English word, what we mean by this is that we mean a financial system that is resilient to both known and unknown risks and shocks. For example, when COVID-19 hit, many of us hadn't heard about it. Then it started somewhere in China. It was an external shock. COVID-19 did not come from Uganda. But it hit us, hit the economy, but our financial system was resilient. It continued to what? To operate. A financial system operates on trust. That if I have my money in a bank, I can go and get it anytime. I won't find that the bank has closed its what? Its doors. If I go on my phone and I want to send some small money to my wife, I will send it and she will receive it and withdraw it. There are many things we do on a daily basis that we take for granted, but there is a lot of work behind those transactions, those payments that ensure that the financial system continues to operate normally and smoothly. Now, when we regulate the financial system, we look at two aspects. Bank of Uganda formulates macroprudential policy, which is aimed at addressing what we call systemic risk. And I want to explain this because these are very big words. Some of you may not have heard of them before. Systemic risk are those challenges that affect the financial sector as a whole. Irrespective of whether you're a small bank or a big bank, insurance companies, pension funds, the capital markets, everybody in the financial sector, the payment systems. A shock like COVID-19 is a systemic what? Shock. Because it affects the whole financial system. So Bank of Uganda formulates policies that are addressed at ensuring that the financial sector is resilient or can ably handle those shocks and continue operating and providing its services. Secondly, Bank of Uganda regulates and supervises individual financial institutions and payment systems. And Dr. Twinemanzi highlighted this in his presentation. We go into financial institutions and do on-site what? Inspections, to ensure that each institution is complying with the regulations, including capital and liquidity. Now, in your assessment And in your evaluation of our presentations today, you need to take both of these into account. Because one without the other will not ensure financial what? Stability. I've provided some examples of the kind of shocks that have hit and are going to hit our financial sector. COVID-19 is known to all of us. You can have problems within the financial sector like rapid credit growth, slow economic growth is a challenge to the financial system because it affects the financial position of households and enterprises, and therefore their ability, for example, to service their loans. On slide number 5, I want to highlight two things, again as part of the preliminaries. The first one is when we say a financial system, what do we mean? A financial system is composed of commercial banks, but also composed of other institutions like pension funds, insurance companies, and capital markets. A financial system is also composed of financial markets. Financial markets are the markets where instruments are traded, like foreign currency, for example, all right? A financial system is also composed of the payment system. The payment system is the one that facilitates the transfer of funds between sectors of the what? Of the economy. Financial stability means that all these components of the financial system should be operating what? Normally. Now in Uganda, our financial system is dominated by the banking sector, which accounts for about 74% of the total assets in the financial system. So there is a lot of focus naturally on the banking system. And the other reason, of course, is that most people interact with the banking what? System. That's where you keep your money. But when you go to your bank and transfer money, or you go on your phone, for those who use online banking, and you transfer money from your account to mine, you are free to transfer money to me anytime. You are using a payment what? System. You don't see it. You don't interact with it. But my colleague, Mr. Kawere here, wakes up every day to make sure that the payment system is working what? Efficiently. Okay. Now, the financial stability is about the condition of the financial system, but also is affected by the way other sectors of the economy work, the households and enterprises who borrow and deposit with the financial system, the government policy affects us all right? As well as the external what? Sector. So when we do financial stability assessment, and indeed in our report today, you'll see that it covers all these different sectors. And I want to conclude the preliminaries by highlighting some of the key functions that a financial system does in an economy. Some of which I've already mentioned, okay? Payment systems, which facilitate the transfer of funds between economic what? Agents. If you go to Nakawa market and buy matoke and pay with mobile money, you're using a payment what? System. Financial institutions and the sector also help in supporting economic growth. For example, supporting investment in the key national projects such as the oil sector. So having a stable financial system is a public policy objective. It's in our interest to make sure that the sector is well capitalized and is resilient in order to support growth. Thirdly, it supports maturity transformation by getting short-term deposits from savers and issuing long-term what? Loans to investors. This is important, although it carries some risks. As Dr. Twinemanzi pointed out, if deposits are short-term but loans are long-term, there is a mismatch, isn't it? So we have to make sure that the banks take into account this match, the mismatch, and are able to deal with it. Now I want to turn to presenting our financial stability assessment. This table, Dr. Twinemanzi covered it in his presentation. So with your permission, I'm not going to go through it a second time. Let me go straight to slide number 7. And on this slide, we highlight some of the macro developments and risks that are facing the financial system at present. It is obvious by now that economic growth, both domestically and internationally, has been disrupted by the supply side challenges, the increase in commodity prices globally, the war in Russia and Ukraine, and these factors are passing through to the domestic economy, especially to our inflation. Any of you who owns a car will have seen that, for example, petrol prices have have increased. Now, most central banks around the world, including Bank of Uganda, have reacted to the increase in commodity prices by tightening monetary policy. For example, Bank of Uganda increased the central bank rate from 6.5 to 7.5% last week. So all these factors, of course, will affect you and me. The economy is you and me, the people on the street. And the challenge, of course, is that this will pass through to the financial system. And we anticipate that this will happen in two ways. In the first instance, as the monetary policy tightening continues, households and enterprises may face challenges in repaying their loans, and this could increase credit risk. And we are saying this will happen if monetary policy tightening does continues. We have not yet reached that point. Most people can absorb an increase from 6.5 to 7.5% in lending in the CBR. But on this, Bank of Uganda is also conducting a stress test of commercial banks, which we shall use to inform any further action in terms of addressing this risk. Turning to funding and liquidity, liquidity is one of the big risks that financial institutions face, because banks need liquidity on a daily basis to pay depositors as they walk in, to meet their ongoing operational costs. So a bank that runs out of liquidity will fail very quickly. But we do note that funding and liquidity conditions have remained very stable, and liquidity risk is very low in the banking sector right now, supported, of course, by growth in deposits, which was about 3.3% in the quarter ending March, also supported by BOU policy action. We saw that the cost of deposits has reduced. This is the cost that banks meet when people deposit money with them. Also notably, the ratio of foreign currency deposits in total deposits has reduced over time, as you can see in figure 4. What this means is that the exchange rate risk that banks face has declined over time. Now, why has liquidity risk improved? The main reason is that throughout the COVID period up to today, banks are putting more of their money into liquid assets. Liquid assets include, for example, things like government treasury bills, okay, and other liquid assets. Why are banks putting a lot of their money into liquid assets? Because the economy is not doing well. So banks are not yet lending or extending loans to the extent that we saw before the COVID pandemic. But they have to invest the funds they have somewhere, right? So as banks have increased their holdings of government securities and say, Bank of Uganda securities, their holdings of liquid assets have increased, which has increased also and enhanced their liquidity buffers. And as a result, if you see in figure 5, you will see, for example, that the two key ratios that we use to measure liquidity, the liquidity coverage ratio and the liquidity ratio, both of them are far above the minimum what? Requirement. In fact, both of them are more than double the minimum requirement. Having said that, we anticipate that going forward, because our report also, we have to do a forward-looking assessment. Looking at the near term, in the next 6 months to 12 months, we anticipate that liquidity risk is likely to increase. One key factor is that as advanced economies tighten their monetary policy, it is very likely that we shall see an increase in the outflow of offshore funds from our banking system. This has not happened yet, and we keep monitoring this on a daily basis, but we anticipate that it is likely to happen at some point, because interest rates in developed countries will start doing what? Rising. So this could see an outflow of offshore funds. What have we done? As Bank of Uganda announced in the monetary policy statement last week, we ended the COVID-19 liquidity assistance program. This is a facility we had put in place at the start of COVID to assist banks that may face liquidity challenges. And it had come to the time, it was timely to end it. It had achieved its objectives. It was a COVID-19 measure. And in its place, we have started implementing what is called an emergency liquidity assistance facility, effective 1st June 2022. This facility is in place to help banks that could or may face liquidity challenges on an ongoing basis and have run out of other options. For example, they cannot access other standing lending facilities in Bank of Uganda or have exhausted their liquid assets. Turning to credit risk, overall we note that credit risk remains, moderate. However, we want to highlight that non-performing loans in the banking system are likely to rise in the near term. And so what do we mean? If you look at the ratio of non-performing loans to total loans in the banking sector, non-performing loans are those loans which are past due by at least 90 days for banks and at least 30 days for microfinance deposit-taking institutions. The ratio, the NPL ratio as we call it, for banks increased to about 5.8% in March, although we saw an improvement for credit institutions and MDIs. Having said that, going forward, we anticipate that non-performing loans are going to increase. Why? Because, as I pointed out at the start, the economy is not doing well. This is obvious. Economic growth remains what? Soft. And anything that affects economic growth affects the financial condition of households, of individuals, and enterprises. Secondly, the inflationary pressures are obvious, all of us. They're happening. And thirdly, we have a large volume of loans under our credit relief program whose repayment remains behind schedule. I will touch on that in the next slide. So what have we done? We continue to engage banks to ensure that they set aside provisions in a forward-looking manner. Bank of Uganda implemented IFRS 9, which is an international accounting standard, where banks set aside provisions, not just for loans which are already going bad, but also set aside provisions in a forward-looking manner if they anticipate that a borrower may default in future, even though he's still what? Performing. The Bank of Uganda also maintained the loan-to-value ratio for residential mortgages and land purchase at 85%. we are working with the Uganda Bankers Association and the Institute of Surveyors to address one of the big problems in our banking sector, the issue of collateral valuation. And then thirdly, for a long time, the Uganda Bankers Association and BOU have pursued the establishment of an asset reconstruction company whose purpose is to absorb distressed loans from the banking sector so that they do not take up a lot of capital or affect bank lending. And this company has now set off and is in operation. Now, I want to give a brief update on the credit relief measures. Dr. Twinemanzi talked about this program. At the start of COVID, Bank of Uganda put in place a COVID relief measures program to help borrowers that were affected by the lockdown, to absorb that shock. If you are in lockdown and you're at home for 3 months, you can't pay your what? Your loan, but it's not your fault, and it wasn't at that time. Now, this program was very successful, and as of today, about 7.2 trillion of loans benefited from this program, which is about 40% of the total loans in the banking sector. And as at April, only about 2.5 trillion of loans remained under the program, meaning that most people have been able to successfully resume repayment of their loans. However, we note that about 1 trillion in loans are still facing challenges in resuming regular loan payments. This is a very large figure, and it is likely going forward that if most of these people continue facing challenges, because some people's businesses were terminally affected by the pandemic. We have to be honest, right? There are people who are laid off in the pandemic who are yet to find jobs. So we are engaging with banks to make sure that the provision for these loans. However, our own stress tests that we have conducted internally show that most banks are able to absorb any losses from these loans without breaching their capital. And as Dr. Twinemanzi pointed out, the targeted credit relief program, which remains in place for education and hospitality, will end on September 30th. Turning to capital and profitability. Now, capital is a key measure of how resilient a bank is, whether it is able to absorb shocks. We note that the profitability and capital of banks has increased over time. In fact, the aggregate core capital ratio for banks increased from 22 to about 24%. And the increase in capital was supported by many factors, including a reduction in costs. Now, given the improvement in capital, Bank of Uganda has taken several measures. One is that we ended the market-wide restriction on payment of dividends, and this ended on 31st May 2022. However, we are mindful that going forward, the potential increase in non-performing loans may affect the profitability of banks. And let me talk a bit more about the restriction on dividend payments, because it has raised some discussion in the press. BOU announced in the monetary policy statement of June 2nd that the restriction on payment of dividends by banks will ended on 30th May 2022. What are our reasons, or what factors informed this decision? First is that it was timely to end it. This was a measure put in place at the start of the pandemic to enable banks to build up capital buffers, and it achieved its intended objectives. Secondly, since 2020, Bank of Uganda has implemented several measures that have locked in the restriction on payment of dividends. For example, we implemented a regulation called the Capital Buffers Regulation, meaning a bank cannot pay dividends unless it complies with certain levels of capital. And also implemented Basel II, which Dr. Twinemanzi talked about. And also the prolonged use of the policy would have been distortionary. So the policy has ended, but going forward, payment of dividends will still be subject to approval by Bank of Uganda. And a bank that wishes to pay dividends must apply and demonstrate that it meets the capital buffers, that it is in compliance with Basel II requirements, and any approval will also take into account the prevailing macroeconomic conditions. So it is not the case that a bank can suddenly pay out what? Dividends. They must still apply. What has been ended is the market-wide restriction. Going forward, we shall be looking at each bank on its merits, okay? The total dividends that banks had applied for but not yet paid are about 576 billion for banks and about 2-something billion for MDIs. Now, Afriland Bank, Dr. Twinemanzi talked about this. The only thing I want to add is that on the 25th May, Bank of Uganda announced that we had given permission to Afriland Bank to apply to the High Court for voluntary liquidation. Now, this has also raised a bit of press and questions about whether the bank is stable, about other banks, and so on. In addition to what Dr. Twinemanzi mentioned, the only thing I want to add is that Afriland Bank is a solvent bank. Okay? It is not insolvent, it does not have liquidity challenges, it is a solvent bank that is normally operating. And secondly, the decision taken by the bank was a strategic decision based on strategic what? Considerations by the shareholders. Okay? And this needs to come out and be able to explain. Now I want to turn to payment systems. As I pointed out, the efficient operation of payment systems is critical in ensuring a stable financial system. Now we have what we call systemically important payment systems. These are the largest payment systems that process the biggest volume of transactions. And we note that they have continued to operate without any significant disruptions, and this include RTGS and the mobile money system. A key development in the financial sector has been the increased use of digital payment systems. This area of digital payment systems picked up considerably during the COVID pandemic. Most people were at home, so if you want to access your bank, you suddenly learned how to use the banking what? App on your phone, as an example. So there has been an explosion of digital payment systems, including mobile banking, which increased by about 146% in the year to March. The volume of mobile money transactions increased by almost 50%. Of course, supported by an enabling environment from Bank of Uganda. However, one thing we are monitoring and we are concerned about is the increased cyber threat within this area, both for mobile money and mobile banking. We have seen, for example, 2 banks affected by cyber fraud in the period to March. And so we will continue to engage with the payment system providers to ensure that they strengthen their operational risk management with regard to payment systems. So I want to conclude by saying that the financial system, from our assessment, remains stable and sound. Systemic risks, financial stability, remain moderate. However, in the near term, we are likely to see an increase in certain risks, including credit risk and liquidity risk. BOU will continue to monitor the evolution of these risks and take action as necessary. Thank you very much.
Thank you very much, Robert. So ladies and gentlemen, that brings us to the Q&A session of this symposium. You'll notice that we have mostly BOU people on this side, on to my right, and also on to my left, but these people are not just here to attend and learn, they're also here to answer your questions. So ladies and gentlemen, if you do have a question, both online and in the room, please raise your hand, introduce yourself and the media house you belong to, and if your question is directed at someone in particular, please mention that person as well. But to recap, we have Dr. Twinemanzi, Tumubweinee, who's Executive Director of Supervision. We have Andrew Kawere, who's Acting Director of Financial Markets. No, where? Sorry, Payment Systems. And then we also have Robert Mbabazize. Mbabazize, people. And yet, these are names from my place. So it's very difficult. All right. We also have Ivan A, I will say that. I will have Ivan A also for financial stability. When did you people move? Oh, I'm reading an old bank placement. All right, we have Mr. Peter Rumanzi also here with us to answer any questions. And then we have Harrington, who shall tell us which department he's from. Commercial banking. So ladies and gentlemen, any questions, media people, we have a full team from the central bank ready and willing to answer any of your questions. So please raise your hand and we'll take it away from there. Can I have some help with someone to move with the microphone behind? Shall we say that all of you have understood? Okay, we have one.
Okay. Martin Luther. My name is Martin Luther Cage from the National Media Group.
A bit louder, please.
Can I move this? Okay, fine. My name is Martin Luther Cage from the National Media Group. Number of questions anyway, but I will start with the Robert. When you are presenting, you highlighted several risks, which are quite understandable. And let us go back to the offshore, where you alluded some kind of risk in form of maybe capital outflow. I don't know whether they can decide to sell it off or what. Now, how much by now are they holding in government securities? And in which one? Is it after that, let us break it down and again ask ourselves, is it in the treasury bills or the treasury bond? Why are they active anyway? That's the question. And then also, when you did mention something like emergency, you just mentioned emergency fund. That would be, I don't know whether it's a fund or what. It is emergency policy that would be standing there as some of the support during the during the high peak of COVID. It has ended. Yeah, you explained it. It was anyway reasonable to end, which is true. To avoid that kind of over-reliance on the central bank, encouraging some kind of weakness. But emergency, what kind of emergency is this? How much is it in, if it is in money form, how much is it? It is in the what? In the place. When I look at this growth here, isn't it too fast? Why is it so much like this? when you look at the, sorry, I've just lost the line. Okay, when you look at the payments, you remember that line? I'm just trying to get it because I want to give time to other people. Okay, I've seen it. The value of mobile money transaction rose by maybe 46.5, 145.6 trillion. And then you raise some fears there. Why wasn't this too fast? Too fast really within a short period of time? Aren't there some risk beyond what you have just said? Let's go back to, Doctor, let's go back to your presentation anyway. I looked at, let me start with the credit review of the Credit Reference Bureau. I was waiting to hear you saying maybe you have expanded even beyond maybe the financial institution, because you mentioned the finance and then the credit, the trade credit. But I was expecting maybe to hear something like maybe from the maybe the telecom or the electricity. Sometimes when I look at your reports, those people have bad loans with banks. Again, Doctor, when you look at the what, I think I raised it some time ago, but are we not so slow a bit? We are just planning to finish Basel II, okay? But other countries are already in Basel III. And ours, again, you have mentioned up to 24 June, something there. Haven't we been very slow a bit, or it was just quite maybe reasonable enough to be there at that pace of movement, really? I looked at that. And then also you mentioned something about the capital outflows. And I was wondering, what is this? Were they removing profits or something else? And how much was it? Let me first stop there. I will come back to you later.
Thank you very much, Martin. And we have these other two questions. Please also don't forget to fill in the registration and evaluation forms that are in the folders on your table. Yes, sir.
Thank you so much. My name is Tadeo William Senyonyi from Business Focus. My first question goes to Dr. Twinemanzi. BOU plans to increase minimum paid-up capital to financial institutions for banks from 25 to 150 billion, right? For Tier 2 credit institutions from 1 billion to 25, and for MDIs from 500 million to 10 billion. Now, my question is, has BOU analyzed the impact this will have on these institutions, especially smaller ones, and then the larger economy? Don't you think this could lead to maybe mergers or collapse of smaller banks that have, assets that are less than 500 billion, and those are very many? This one goes to Robert. I would like to get more information about this asset reconstruction company. How is it operated? Who operates it? How does it work? And basically, who finances it? Thank you so much.
Okay, we'll have one more.
Should I stand? Yes, morning. My name is Ali Twaha and I work with New Vision. Just thank you for the presentation, Mr. Twinemanzi, and I've also forgotten the other name. I'm sorry, but I know for Twinemanzi. I just have 3 questions, short ones. One of the big things we saw when the pandemic came was the closure of branches. And from the last report, I think Mr. Twinemanzi highlighted about 30 branches specifically for the MDIs closed and a number from the commercial banks. Now, what I wanted to understand, yes, this might be in the detailed report, but for purposes of the TV and broadcast, we want it on record. I just wanted you to take us through the numbers in terms of branches. The DG last time noted that he indirectly said it's good if they close as long as people are getting the services. But I wanted us to understand the impact of closure of the branches as they move to alternate banking channels. Then second is on, I've been looking at the statement of a bank as at close of December 2021. And its NPLs, we talked of the risk going up, but where I saw nearly 30% of its loan book being non-performing, it's sort of a red flag, although they increased the core capital slightly. I just wanted Mr. Twinemanzi to tell us what this really means. I don't want to mention the bank. Yes, but nearly 30% of its loan book was non-performing. I don't know if you saw that. And I wanted on the CLAP, the COVID liquidity assessment program, since you rolled it out, how much assistance in terms of value? As at end of May, I saw a bank took about 70 billion in assistance. But in general, that's not what I wanted to focus on, but in general, in terms of support and value, in terms of liquidity assistance for the CLAP program, how much have you given the banking system? The last one is on dividends. Last week, we had a AGM for one of the top banks, actually the top bank, and the issue of dividends for many stakeholders, for shareholders rather, for 2020 were silently swept under the carpet, but they gave us dividends for 2021 and an interim for 2022. So we were asking how come 2020 disappeared and then they are giving us an interim. Of course, Bank of Uganda approved their 100 billion that they are going to give us. I just wanted clarity on that issue from your point of view. Thank you.
Okay, thank you very much. Let's take those 3 questions, then we'll come back to that one. But Ali, you have to tell us at that AGM, were you there as an investor or as a journalist? As an investor. We want to make it very clear. We don't want bloodlines here. Okay, so over to you, Doctor and Robert. The floor is yours.
I'll start with the gentleman on the CRB. Remember when I talked about the Credit Reference Bureau regulations being amended? I said they are being amended to allow to capture information for both financial and trade credit. What do I mean by trade credit? That's not financial credit. If you receive a service and pay for it after consuming the service, that entity, the service provider, has provided you credit because you have enjoyed the service, but you haven't paid for it at the time you enjoy the service. You consume it and then pay for it after. That is trade credit. They have not lent you. They have merely said, take the service, you pay after. And now that will cover things like utilities. Yaka these days is now prepaid, so it's no longer even mentioned in that space. But things like purchase of vehicles, where you are allowed to maybe pay a deposit and pay the balance over time. That is trade credit. Essentially, the car dealer has given you credit. And that is referred to in finance, that's referred to as non-financial credit or trade credit. Okay? So the amendments, just provide clarification, are going to mean the amendments to the Credit Reference Bureau regulations means that umeme, before they connect you, okay, or after they connect you, will now be required to start reporting to the CRB on the performance on how well you pay your electricity bills. If they send you a bill and say you have 1 week to pay, if you pay after 2 weeks, they'll report it. Landlords, maybe perhaps if you're getting credit from supermarkets or from gas stations, anyone who provides credit in any form will now be allowed to submit information to the CRB, but also more importantly, get information from the CRB. Now you're going to say, but wait a minute. If I'm buying a car, I don't need an FCS card. No, what the Credit Reference Bureau regulations, the revised ones, which should be coming out soon, is that your national identity will be reported upon. This way, when you finally walk into a bank to borrow money, one, you won't need an FCS card anymore. All you need is your NIN, which you already have. Okay? When the bank is making the decision to lend you money, they will look at how you have used other forms of credit outside of credit you've gotten from other financial institutions. So the business of saying, since the FCS card is only for banks, I can go to a money lender, default, but pay my service, my loan in the banks. No, you're going to have a comprehensive 360 degree of how you handle credit anywhere within the economy. I think that answers the question. There was the question about the asset reconstruction company. Let me just explain a bit how, and expound on what my colleague Robert said with the asset reconstruction company. It purchases distressed debt or distressed assets. And this is how it works. If someone has borrowed money from a bank, perhaps you're running a factory, and you're having a problem paying back the loan, what the asset reconstruction company does is goes and talks to your bank, of course you'll be part of the conversation, and buys that loan from the bank. So the bank you no longer owe the bank money. Then the asset reconstruction company will work with you to rehabilitate your asset. Maybe perhaps it's a question of maybe you need extra money and the bank thinks, no, we already lent you X amount, we can't add you more because you're already at risk, you're already having a problem paying. If you're having a problem paying 100 million, I can't add you another 100 million, I'll just be making the burden worse for you. But because the asset reconstruction company is using private capital, they are actually private equity funds and a few institutional investors, they work with each of these borrowers to try and reform or rehabilitate the loan, and then when that business gets back onto its feet, then it can repay them back. So think of it as almost like rehabilitation finance. Okay? On the capital outflows, this is what we have noticed. If you look, a significant number of, there's an amount, a sizable amount of the government treasury bonds and treasury bills that are bought by external institutional investors who come to Uganda looking for better returns. I'll give an example. The current 30-year treasury bond in the US has a rate of 1.75% in dollars. But the 25% here has a coupon of about 16%. No brainer. Even though the one here is in Uganda shillings, the other one is in dollars. So what some either pension funds or external investors do is convert their dollar holdings into Uganda shillings and buy the treasury bonds, okay, in Uganda shillings. When we say we're seeing reversals is that because advanced economies are now increasing their interest rates, the yields on their own government paper or government bonds are increasing. So what these institutional investors who have come to Uganda, what we've noticed is increasingly that they are now selling off their bond holdings, converting that money to dollars to take it back to their home countries. And that is a normal course of business. Money will always move to where it earns the best yield at the least risk. Okay? The increase in minimum capital. what's the impact on banks and on the wider economy? Remember I said earlier on, when banks lend, they don't lend their money. They lend my money, they lend your money that we deposit with them. And the amount of capital a bank holds determine how much loans it can make. Because if you're only holding capital, say, of 1 billion shillings, but you've made loans of 300 billion, if 20 billion of them go bad, where are you going to get the capital from to reimburse the depositors whose money is now at risk? So when we came up with the increase in minimum capital, which was last year, when we made the announcement, the thing was because, like I said earlier on from our risk assessment, we saw that going forward, these banks, for them to remain stable, sound, and resilient, in order to continue to have the ability to absorb the shocks the economy is facing, these shareholders of these banks need to put in more money. Because, like I said, and Robert indicated, we anticipated and are beginning to see an increase in credit risk, an increase in the possibility of default by borrowers. When the borrower defaults, it's not so much the bank that suffers. It is potentially you and me. Now, as a regulator, my responsibility is to make sure that irrespective of the performance of a borrower, your money as a depositor will always be available to you as and when you need it. The way to do that is then to require the banks to hold more capital for larger balance sheets. So that's why you'll find, for example, some banks, like the biggest bank in this country has probably a capital of about 600 billion shillings. But then you look at their balance sheet, they have loans and advances of about 4 or 5 trillion. So for them, they have the ability to absorb up to 30% or 40% of their loan portfolio going bad. And that is why we increase the minimum capital. What does it mean? It means that shareholders of the banks are going to have to make a decision. Do we want to stay in this market? If not, they apply for voluntary liquidation, or we, in an orderly manner, since they came in an orderly manner, we escort them out. And only stay with those who have the ability not only to provide credit here, but to do it in a manner that reduces the risk to depositors' funds. Does it mean we might have mergers? Yes, we expect to see mergers. Are mergers a bad thing? No. Because if you have 2 institutions merging, you potentially are building, you have 2 institutions with different synergies, different capabilities. When they merge, they become stronger. So sometimes, the strength of a merger is normally a function of the strength of the individual components. If 2 individuals are getting together to increase their ability to be able to survive and be resilient in this economy, that is a fantastic outcome. What does it mean for the wider economy? It means that for the wider economy, you're going to have financial institutions, those that will remain, that are better able to continue providing credit, but in a manner that reduces the risk to depositors' funds, which I think, in my assessment, is one of the reasons they resort the tray for the establishment of Bank of Uganda and for why we have regulations for the banking sector. Closure of branches. This is a business decision. This is one thing I think most of the banks saw, and a number of you who have your own private enterprises have seen. The banks began to realize that during the closure, restricted movement, containment measures, they could continue to provide the same services with fewer people. Okay? That's 1. 2, we have had a phenomenal growth in agent banking. So why would you want to have a branch and have, maybe in a trading center or something, a branch is most likely not even profitable, and yet you could service and have so many agents in the same area, and yet you could service those agents from somewhere else and still provide services to your customers, which is what I think the Deputy Governor meant. He said that really the closure of branches is not what really matters. What really matters is the expansion, is the access to services expanding. If it is, how it's done really is not of major concern. 30% of loan book being NPL. Presumably this institution that you talk about has adequate capital. Because when you said 30%, I actually turned and asked you, which bank this is, because my records don't seem to indicate that such a bank exists. But in the event it does, our concern as Bank of Uganda will be, you can have a non-performing loans even of 40%. How much capital are you holding? If you're holding capital that can cover it, we're okay. Because like I said, our responsibility is you, the depositor. That every time they lend out your money, and there's a risk that it might not be returned on time, that bank must have its own capital to do what? To replace the depositor's money. Dividends. Yes, I'm aware. Stanbic had its AGM last week on Thursday. And you are asking what happened to the 2020 dividends? Because they only paid for 2021 and declared an interim dividend for 2022. Again, what I believe Stanbic chose to do was to retain the dividends of 2020. And if you want to understand what happened to that money, look at the provisions of Stanbic in the Stanbic financials, since you're an investor. Look at their balance sheet for 2020 and their balance sheet for 2021. You'll notice one thing. The amount of specific provisions increased by almost 100%. In other words, the dividends, instead of paying out dividends, they chose to keep them to cover and reimburse depositors in the event they increase their loans on their balance sheet went bad, which is normally a prudential decision. So it's not unusual, but I think it was very prudent on their part to withhold dividends from 2020, use them to increase their ability to absorb losses in 2021, and then just declare a small dividend from 2021 and pay an interim from 2022. The last question was on the pace of Basel II implementation. Isn't it too slow? If you look at where we are on Basel II, we are moving to full implementation, okay? But I don't know if you noticed this, but there are some aspects of Basel that can't be declared and required to be enforced within a month. Some require a bit of time to fully kick in. And that's why we are saying we put a definite cutoff that at the latest, the banks must have the full implementation of Basel II will be June 2024. Remember, one of the requirements of Basel II is that now banks, for each of the risks, credit, strategic, operational, and there's another one, liquidity, market, they have to hold capital specifically for each of these risks. And that's why we're conducting the ICAP. So some of them are finding after the ICAP that I should be holding capital of 100 billion, but I only have 60. I need to say, as the manager, as the directors, the management, they have to go to their shareholders and agree by which time they should have this money brought in. Okay? Remember, this Basel II is separate from paid up capital. And I want to make that distinction here. What Basel II talks about is ongoing capital requirements, that the amount of risks you hold in terms of loans on your balance sheet increase, there is a certain proportion of either retained earnings or your paid up capital that you must hold. Now, to compel them to move faster along this journey, we increase the minimum paid up capital. Then next, as they take on risks, in other words, lending, like Robert explained, where you get volatile short-term deposits from me and you deposit your money today, you pick half of it tomorrow, but they are going to use that money to lend to him for 5 years. Managing that liquidity mismatch requires you to hold a certain amount of capital on yourself, which perhaps you invest in treasury bonds or treasury bills, so that every time the cash inflows from the treasury bonds can then be used to meet those needs for liquidity. I don't know if there's any other question here, but I'll now ask perhaps Robert and then Andrew to come and answer the other questions. Thank you.
All right, thank you very much. I will start with a question that came in via YouTube. And it says, please enlighten me on the Real Estate Investment Performance Index and if it exists in Uganda. And secondly, what factors informed the loan-to-value ratio for mortgages of 85%? On the first question, the answer is simple. We have a residential property price index. For Uganda, this index is compiled by the Uganda Bureau of Statistics. It is available on the website of the Uganda Bureau of Statistics and is available to everybody. You don't have to pay for it. But in addition to it, we do have property price indices that are compiled by private companies, and they charge for these indices. So yes, there are indices in Uganda that exist, and you can access them. Now, returning to the loan-to-value ratio of 85%, why did we set it at that level? I want to start by pointing out that this limit was set in May 2020. And at that time, there was concern that banks, because most banks in Uganda take collateral for loans, but that collateral is mainly in the form of property, either residential houses, land, or commercial houses. As the value of that collateral varies in terms of the prices that it attracts, the exposure that banks face also changes. So if you see a reduction or an increase in property prices, it translates into the exposure that banks face or a potential loss that they might face. The indicators we saw at that time indicated that we needed to set a limit on the loan-to-value ratio for banks for residential mortgages in order to address that potential exposure. Why did we set it at 85%? That was informed, one, by the data that we were seeing, especially within the banking sector. We did do several surveys, and as we said, we monitor this on an ongoing basis. We consulted with the commercial banks. We wanted to take into account the challenge with collateral valuation, which I talked about in my presentation. In this country, we do have a challenge whereby some banks, for example, when borrowers default on their loans and banks go to collect or to sell the collateral, then they find that the valuation was far higher than the actual value of the property. So that gap of 15% takes into account that potential exposure. Now, having said that, of course, some banks have more tighter LTV ratios than the 85%. But our indicators show that so far, this policy has worked very effectively at mitigating risks from movement in real estate prices. Then secondly, there was a question on CLAP, the COVID-19 Liquidity Assistance Program. And specifically, was it successful, and how much money did banks access from this facility? I want to start by saying that the amount that banks accessed from this facility is not important. I want to make that very clear. What is important was that the objective of the facility was to address market-wide liquidity problems within the sector. In other words, to give confidence to the banks that they had a backstop in case they run into problems during COVID. Okay? If you look at this graph, figure 3 on slide number 8, the area that is circled is the period around March and April 2020 when COVID came. As you will see, there was a lot of volatility at that time. That volatility came about because banks at that time were not sure of the counterparty risk between them, i.e., some of the banks stopped lending to other banks because they were not sure that they would be what? paid back. So the interbank market was facing some very serious challenges. Liquidity is a key issue in banking, because if you cannot access funds, then you cannot operate. So CLAP came in and was introduced by Bank of Uganda in April 2020 to address those challenges. And as I said, it provided confidence to the sector. The interbank markets normalized. Banks had the confidence that, you know, even during lockdown, if they needed some money, they could access it from Bank of Uganda. Interbank rates, that is the rate that banks charge each other to lend to each other, normalized, although they had gone beyond the central bank rate bounds. And over the two periods, to April 2020, that situation continued. As we've said, our banking sector is awash with the liquidity. Now, CLAP was a COVID-19 measure, and it was time to end it, okay? And it achieved its objectives. But specifically, to turn to your question, most banks that accessed the facility accessed it at the beginning of COVID, around April to August 2020. Because as you know, that was a period when the economy was, all of us were in our homes, isn't it? We were watching TV, waiting for His Excellency to announce therefore this and that, and give us direction, okay? So most banks access CLAP at that time, but we have ended it. Now, there was a question on the Emergency Liquidity Assistance Program. I wish to make one clarification. The Emergency Liquidity Assistance Program is not a continuation of the COVID-19 program, no. The COVID-19 program was specific to COVID, and it has ended. The Emergency Liquidity Assistance Facility is what we call the lender of last resort facility. And it is a normal facility. All central banks around the world have a lender of last resort facility. This is a facility that banks will access when they have exhausted all other avenues of getting what? Money, such as borrowing from other banks or discounting their government securities, and so on and so forth. So we have set up this facility, and it started on 1st June. It is not to say that we did not have a lender of last resort facility before. We had such a facility, but it needed to be reformed. And the setting up of the ELA facility is the culmination of those reforms, whereby we set up a separate facility in 2020, which is called the Standing Lending Facility. From that facility, banks can borrow automatically, as long as they have government what? Securities. And it's a monetary policy tool. So as long as you have government bonds and you have some liquidity challenges and you're a bank and you're eligible, borrowing is automatic. Emergency liquidity assistance, on the other hand, as I've pointed out, is a last what? Resort. To access it, you must have exhausted your government securities, for example, meaning you cannot access the other facility. You have to be solvent. So we cannot lend to a bank that is collapsing, that is insolvent. And then thirdly, the Bank of Uganda will put you under more intense monitoring and supervision on a daily basis. And you have to submit a liquidity restoration plan. Under this facility, the Bank of Uganda may consider taking on additional collateral to lend you money. For example, we might accept bonds that are issued by the corporate sector. We could accept a portfolio of loans, but these have to be very high quality and performing loans, okay? And the key word here is we may take on that collateral. The decision at the end of the day remains for the governor to make. Thank you, Andrew.
Thank you, Robert. There was a question from Martin from the Nation Media Group. He asked whether the growth in mobile money transactions wasn't so fast. Let me see if I can get to that slide. Yes, he asked whether the 46% growth in mobile money to a value of 145.6 trillion isn't a concern for us as the central bank, and whether there are any risks to it. So, one, that growth is considered low. And why is it considered low? Late last year, Bank of Uganda, working with the Uganda Bankers Association and the payment service providers, mobile money operators, if I may use that term, developed an e-payment strategy, a 5-year strategy. And in that strategy, we are looking at very, very ambitious growth targets for e-payments. We're looking at growing the e-payments transactions by more than 300% over the next 5 years. So if you take that target in the e-payment strategy and compare it with what you see on the screen, mobile money is actually the least performing. Look at the growth in internet banking and mobile banking, 82% and 146% respectively, while mobile money is at only 46%. So whereas it seems huge, it is actually below our growth targets. As part of the strategy, we are aiming at having a cash-light economy. The studies, the FinScope study of 2018 estimated that cash transactions in Uganda account for about 80% of the entire transactions in the financial sector. Now that is very, very cash heavy. So we want to bring that down as part of that strategy. And the 46% you see there is not satisfactory to us. Now, are there any risks? Yes, of course there are risks. And the main risk with regard to mobile money is around operational risk. More specifically, issues around cybersecurity and fraud. That is what keeps us awake as we aim to promote these digital channels. Operational risk, cybersecurity, and related fraud. And you might have seen, this is kind of complicated by the low levels of digital literacy in our population. Although we are making strides in terms of financial inclusion, the low levels of digital literacy remain a hindrance and a vulnerability through which cyber fraud and related issues continue to materialize. So you must have seen our officers engaging the public on radio, sometimes on TV, and we're trying to educate the masses in terms of digital literacy. And you're going to see Bank of Uganda coming out more proactively in the coming months to educate the public on digital literacy so as to stem these growing concerns around fraud. We are also stepping up our oversight activities as a regulator. Now that we have a clear mandate under the National Payment Systems Act, we're stepping up our oversight activities through our direct interactions with the licensed entities. Lastly, we are also working on a consumer protection regulation. Now, this is going to give Bank of Uganda very explicit guidance in terms of the regulatory response for matters pertaining to consumer protection under electronic payments. It will also have explicit obligations for the licensed institutions in terms of what they must do under certain circumstances. Thank you.
Thank you very much, Andrew and Robert. A round of applause for those two. Doctor, you have another response? Any other questions, both online and in the room? Please let us know and we'll come straight to you. Thank you.
Yes, thank you. Now, we've received some extra questions. That's why do we allow government borrowing from the domestic banking sector, and which leaves borrowers like you and me and you to suffer from high interest rates? Basically, the question is, first of all, let's understand, why does government borrow? Government borrows when its revenues are less than its needs for its budgetary needs. If you have a budget of 40 trillion and you're only generating revenue of 20-something trillion, then you have to find the difference. The difference is borrowed. Now the question becomes, where do you borrow from? You can borrow from external parties, that's the World Bank, China Exim Bank, and African Development Bank, and so on, but those borrowings tend to be specific to certain projects. But there's certain borrowing that's needed for operational purposes, for recurrent expenditure. And that's what sometimes we call deficit financing. It is not a problem to finance, to do deficit financing to borrow. Now, when government is borrowing, it has two options: borrowing dollars or foreign exchange, or borrowing Uganda shillings. When government borrows in foreign exchange, it takes on foreign exchange rate risk, meaning if I borrow today $1,000 at 3,800, and the day I'm due to pay it back is 3,900, I'm losing 100,000 shillings. Okay? So government sometimes will say, we've got to do the cost-benefit analysis and the payoff analysis of, do we borrow in foreign exchange and increase the foreign exchange rate risk that we face, or do we borrow domestically in Uganda shillings, and since our revenues in Uganda shillings, we won't have a problem repaying. Now, when government comes and borrows from the banking sector, it doesn't borrow really from the banking sector per se. What the government does is it issues either treasury bills, which are with duration of less than a year, or treasury bonds. 2-year, 5-year, 10, 15, and I think now 25. 20, yeah. So, it instructs, the Minister of Finance will then instruct Bank of Uganda to issue these bonds. The bonds are then sold to the public. Okay? You, me, anyone else can participate. And remember what I talked about earlier in terms of reversal of capital flows? It is those kind of bonds that foreign investors come into to purchase, because why? The yield or the return in Uganda shillings is higher than what the return is in dollars for a similar period and a similar amount. Okay? So when government borrows, yes, I agree, it ends up, the rate at which government borrows becomes the floor. So if government is coming to borrow money, issues the treasury bond for 2 years, and pays 12% per annum. Me and you, when we walk into our bank, we can't borrow less than 12. Why? Because government cannot fail to borrow, cannot fail to repay back money in its own currency. In the worst case scenario, they will just merely print more. So, and that's why government bonds, when we are rating them for the risk of default, their risk weighting is 0. Government cannot, it's impossible for a government to default on loans in its own currency, which it issues. But correctly, that forms the lowest amount, the opportunity cost of lending. If a bank is to lend to Twinemanzi or to government, I walk to a bank, I want to borrow money for 2 years. The government of Uganda comes in and says, we want to borrow for 2 years. Who is a better borrower? The government of Uganda. Okay? And if they also decide to lend me Twinemanzi, they'll say, okay, we'll give you at the rate which the government of Uganda is willing to borrow for the same period, plus a margin. What's in the margin? The probability that Twinemanzi will default. The probability that Twinemanzi will go to court when he's due to pay the money and prolong the process. The probability that Twinemanzi has given collateral, which is a chichupuli. It's land in a swamp, but he says it's on a hill. Okay? All these things, the banks compute them, and of course covering the operational costs. And that's why now if government is borrowing 2-year money at 12%, The cheapest you can get 2-year money in a very good bank would probably be about 17 or 18%. That 5% covers all those risks plus their profit. Remember, they are not Oxfam. They have shareholders who want a return because the shareholders have deployed their money to do the business. So, can we stop government from borrowing? No. It is part of the fiscal policy, the management of government revenues and expenditure. When government borrows, normally they're expecting that the revenues they will receive will at least be able to cover the repayments on that loan. Let's look at other countries and see what happens. In the US government has a GDP of about 17 trillion. What is their public debt in terms of government issued bonds? About 1.5 times that. So it's not so much that the borrowing, it's why you borrow and how it's used. Now, if you want to ask a question in terms of the management of those revenues and expenditures by government, Bank of Uganda is the wrong institution to ask. That question will go to Minister of Finance. Next, someone then asked, and this is a very interesting question, how can I sign a loan by mistake? No. What I will do, I won't answer this question. I will answer another one. How not to sign a loan by mistake? I think I will have answered the question. Every time, and we have issued financial consumer empowerment guidelines, I think of 2013 or 2011. 2011. Every time you apply for a loan, and the bank makes you an offer, you have the right to disagree with any of the terms in there. You can say no. That's one. Two, that loan agreement has a provision which even says that you are advised to seek independent guidance or advice before you sign the loan. They even go further. They say that there is a part you have to sign on the loan agreement which says, I have read, understood, and expressly agree with the terms of this loan. Essentially what I'm saying, and it turns into what it's related to what my colleague Andrew Kawere said. We are not financially literate. Before you sign a loan, make sure you understand the terms and understand the consequences of those terms. Because under Ugandan law, a contract is binding. So, my guidance, my advice is, before you sign a loan agreement or take on a loan, make sure you read and understand it. Okay? Educate yourself before you take on a loan. And try and avoid a situation where you are both desperate and ignorant in dealing with the bank. Remember, these banks have the capacity to hire very good lawyers, and they've got very brilliant people working there. So, the Financial Consumer Empowerment Guidelines of 2011, you should all make it a point to read them because they state what your obligations are as a consumer of financial services, but also how you can hold banks accountable in terms of how they deal with you. Then, there's one question, I noticed something we kept on saying, all of us, those who are presented here, which perhaps I think I should provide some clarity on for the benefit of the public and those listening. Is, we kept on talking about liquidity, why banks sometimes have to borrow from each other in the interbank. You might then ask yourself, but the bank is receiving deposits from people. Why does it need to borrow money? Why would the bank need to borrow money? Maybe from another bank, or even from Bank of Uganda. It goes back to how banks conduct their business. When a bank receives 100 shillings of a deposit, 8 shillings is kept with the central bank as a cash reserve ratio. So that now leaves it with 92 shillings. Of the 92 shillings, the bank lends it out. But you who deposited the money might most likely come in, if you deposit the money at 9, it takes off 8, keeps 92, lends the 92 at 10 a.m. You come back the next day at 10 and you want 50 shillings. The bank must have money from somewhere to give you. So either the bank has received deposits from someone else to give you, or if it has lent out most of its money is unable to meet your need, it would have to borrow from other banks to cover that's now a liquidity shortage. It would have to borrow from other banks. Normally the lending is within the day. If the other banks can't give it money, maybe because it doesn't have qualifying securities, the Bank of Uganda has something called an intraday liquidity facility where we automatically fill that gap, allow the bank to continue providing services to customers, but by the end of the day, it must restore it. Otherwise, it turns into an overnight loan. So that is why banks would borrow, because they have to manage, and I think Robert called it the liquidity mismatch. They have to manage the difference between I receive money which can go out anytime, but I make loans which generate revenue for me, which I recover over a long period of time. In between, I have got to make sure that I have got cash flows either from lendings to other banks or access to money from other banks or other institutions to cover any liquidity gaps. Thank you.
Thank you very much, Doctor. To recap, your response would be to water it down, and also I still like my job, so I will not be recapping your response to loans. Next question, and then we have a response from Hannington.
Jumbo is my name. I work with the New Vision. Just have about 3 questions. One is about the credit reference. From the explanation, from Dr. Twinemanzi's explanation, there seems to be a challenge in the market. I would just like to know that, or what challenge there is in the market that you're trying to cure this with this review. And after the review, how will this improve the business of how will this improve and the customers? I would just like to know how this will play out in the market. How will it affect business, and what difference will it make for the customers who take mortgages? And then on the offshore capital flows, I would also like to know how this is likely to play out in the market. Then banks preferring liquidity assets to long-term, combined with the offshore capital outflows. Does this come out as the risk of the liquidity that has been referred to in the presentations? Thank you.
Thank you very much. Rita?
Thank you very much. Dr. Twinemanzi, these are, I have one, my name is Michael Baleke, I work for CGTN. And Dr. Twinemanzi, please accept this general question. I would like to find out what the real impact has been on the financial sector, the impact of the geopolitics. And in this case, I'm speaking about Europe and, of course, Europe, Ukraine and Russia, and also Eastern DRC. I would also, of course, in the outlook, would like you to give us some kind of outlook, because we also have the Kenyan elections coming up soon, and how will this have an impact on the sector? Thank you.
Okay, Ali, and then we shall have the answers.
Yes, my name is Ali again, New Vision. I think since BOU officials are all here, we don't normally get a chance to ask all the questions. But I think on the menu, we would have included the recent financial capability survey of 2020, which made headlines in the New Vision and across other media platforms. Regarding the figures that we saw, if I can highlight the 1% of adults earning less than more than 1 million shillings, and half of Ugandan adults, earn less than 150. When we ran some of these stories, of course, some people said we didn't interpret them very well. But since BOU officials are here, let's put flesh to some of these figures and let our audiences understand. Thank you.
Timely question. All right, so we're now going to go into the answer. You want Doctor to go first? Doctor. Once again, when you're please answering a question, please direct it to who you're answering it to make this easier. Thank you.
Okay. The first question, what mischief is being remedied with the Credit Reference Bureau regulation review? If you look at the Bank of Uganda assessments, and I think it goes far back as the original paper done by Dr. Semogere, that was in 2004, in looking at the pricing of interest rates and spreads. And all subsequent work, including work which was done recently by the International Growth Center last year, where I had the privilege of being the moderator. One of the key drivers of the pricing of interest in this country is information asymmetry. Information asymmetry in the sense that when a potential borrower stands in front of a credit officer, the credit officer has no way of objectively determining the capacity of the borrower to repay the money, but also more importantly, the willingness of the borrower to repay. Sometimes the capacity to repay can be assessed. Look at the borrower's, pay slip, if it's an individual loan. Look at the company's financials, audited financials, as an indicator of the company's ability to repay. That's capacity to repay. The more difficult part, which is why we pay the interest rates we pay in this country, is that now that credit officer says, okay, you have the capacity to repay. What is your willingness to repay? Because I might have the capacity to repay and I just refuse to repay. That also goes into the pricing. What does the Credit Reference Bureau do? A Credit Reference Bureau says, you can look at my pay slip, look at the cash flows of my company, but also now come and separately assess me for the way I have handled credit in the past and my willingness to, which is a reflection of my willingness to repay. So what we are trying, the mischief is that disconnect, that information asymmetry between borrowers and lenders, which has got a very pertinent effect and influence in terms of the pricing of loans. So that's what the CRB regulations, that's the mischief they're trying to remedy. Reduce the information asymmetry. It cannot be eliminated, but reduce it significantly. Because if I have the capacity to repay, but from my CRB, I am constantly late on paying for electricity, I am constantly late on paying maybe my postpaid phone, I am constantly late on my payments for my car, then now the credit officer has a better picture of who this person is. That this is a person who has the capacity, but willingness to repay, not good. If they go ahead to lend, they will have to reflect that unwillingness in a markup, maybe an extra 0.5% or 1% over and above the government treasury, the government borrowing rate for that period, tenor of loan, with 2 years, 3 years, 1 year. Benefits to customers of the mortgage refinance institutions. Today, when you borrow money from any bank, you face a variable interest rate. Why? Remember that the bank is lending you money which is short-term and very volatile. The deposits come in today. If they lend them out, what if they get no deposits tomorrow but you come back for your money? So the banks price that variability and insist on providing variable rates. That's why when you have a mortgage, even if it's a 10-year mortgage, when the rates go up, the bank sends you a notice and says your rate has also gone up. Okay? Now, so it means there's an extent of market failure in the pricing process. So what the mortgage refinance institutions regulations are going to do is allow for the establishment of institutions where when you go to your bank, get a variable rate mortgage, say 100 million to build a house, they say 19.5% for the next 10 years, but they'll put in a clause, and you'll read all the arguments, they put in a clause and say, we reserve the right to keep on adjusting this rate. The bank then will resell this mortgage to a mortgage refinance institution. And your rate then stops being variable and instead you get a fixed rate. So that for the next 10 years, you know that your rate is the same. Okay? So that means the mortgage refinance institution, what it does is that it absorbs the interest rate risk. The potential loss or gain that might come from interest rates going up or coming down. So a small illustration. If I go to a bank and borrow at 19, okay? If the mortgage refinance institution comes over and takes over that loan and keeps me at 19 for 10 years. Now, if interest rates in the market rise to 20%, the mortgage refinance is now losing 1%. However, if they come down to 18, it's gaining 1%. So it assumes the interest rate risk on borrowing. And that is the main benefit. That now you as a borrower, when you are planning, when you take on a mortgage, you know that my payments every month are going to be this for the next 10 years. That is the main benefit of mortgage refinance. That's one. Two, the second benefit of mortgage refinance is that banks will rarely lend money beyond 5 or 6 years. Why? Because of the kind of source of funding, the deposits they use to create the lending. Mortgage refinance institutions, because they come from institutional investors, pension funds, who have a much longer outlook, are a bit more patient. Okay? So when the bank makes a short-term loan to you for the mortgage, it gets bought off, and the 10 years is extended, say 10 years, the monthly payment is the same because the interest rate is not changing. All that is absorbed by the mortgage refinance institution. So the benefit is, one is that now we can start having a market where we have mortgages of 15, 20, or even 30 years. Because if, for example, NSSF was to put money in a mortgage refinance institution, when you start saving, putting money in NSSF at the age of 25 when you leave university and you're going to retire at 60, those are 35 years. Whatever money you put in, NSSF does not have to have it until 35 years down the road. So they can afford to make loans of 35 years because that's when you will need the money. So it means that the two benefits are fixed rates and longer duration or longer tenors for the mortgage loans. Was there another question? Yes. The impact of some of these external developments, the events in DRC, Russia and Ukraine, and the Kenya election and the real sector. Allow me just take a step back for illustration and go back to 2008, the global financial crisis. When it happened, and I do remember at the time the then Minister of Finance stating that Uganda would not be affected. And indeed, we were not affected in 2008. Go back and look at the numbers. We were not affected in 2009. No, in 2010. The impact came in 2011. If you remember that election where treasury bonds were going for what, 22%? In other words, events in the external sector tend to happen in Uganda with a lag. So Russia and Ukraine are fighting today. We haven't yet felt the effect yet. What we are seeing today is from 2020. The lag has come, basically the chickens have come to roost for COVID. For Russia and Ukraine, that is for next year. There is a lag. So, yes, we know that it happens, and some of the mechanisms he was talking about being put in place by Bank of Uganda will address those going forward. And that's one of the reasons, by the way, which ties in with one of the reasons for requiring the banks to hold more capital. Because we know that down the road, these effects are going to come. We might not see them today, but they're going to come. So Ukraine and Russia, we have not yet begun to feel it yet. Don't even worry about that one now. I think worry more about the impact of COVID in 2020 and 2021, the lockdown, the unwinding of the measures put in place, and that's the impact we're feeling today. Next year, that's when Russia and Ukraine will come to us. But however, even full, of course, there's some short-term effects. Part of the effects are coming through. We've seen an increase in prices of some of the imports, energy, wheat for some, because apparently we're importing quite a bit from that region, fertilizers. But the full impact of this event, that in Russia and Ukraine, will only come next year. What we are seeing is think of it as the appetizer of the impact. So what I will do is respond to the appetizer of the impact, not the main cause. Okay? The Kenya election. In the past, they've always tended to see some adjustment in flows around that election. Perhaps there's an expectation that some of the businessmen or entities in Kenya might temporarily move some of their assets to Uganda while they wait out the outcome of the election before they promptly move back them again. So there might be, and I'm not saying this for sure, but there might be an impact on the exchange rate. Now, where those assets come in as dollars or as Kenya shillings will affect the respective exchange rate, but that is possible. So my short answer is the impact of Ukraine, not yet. The impact of DRC, that one is largely now on the fiscal side in terms of the budgetary reallocations to fund our activities there. And I think, again, that's a question that's best addressed to my colleague, the PSST, and his friends in the Ministry of Finance. Thank you. I was going to ask Robert to answer that one, and I think he will address it. But like I said earlier on, capital moves to where it receives the highest return. If there are concerns or risks about realizing that return, the capital moves. We have an open capital account, and unless you say we have start putting in restrictions this time, which has implications, money will come and go. I think the more important question is the Bank of Uganda, from a monetary policy perspective, and the government of Uganda, from a fiscal perspective, in a place able to handle those inflows and outflows as and when they happen? And I think the answer is yes.
There's a question that has been directed to me. My name is Hannington Waswa, Director of Commercial Banking. There's a question that came through YouTube, and they were saying, why don't we trim interest rates like our neighbors? I think it shouldn't be neighbors, but neighbor. I think it was in early 2013, around there, when Kenya introduced caps on interest rates through the Donde bill. And the effect was, yes, let's cap how much people should be paying on loans. Imagine if that kind of scenario played out here. Bank of Uganda today is talking about financial stability and other policies in the monetary policy statement that were read out are intended to encourage credit growth in the private sector. Because if we came up and capped interest rates, it means banks will fold their hands and say, now that the central bank has capped interest rates, we shall not lend. You and me will not be able to finance your businesses. What will happen? There are so many people who depend on the employment you create when you set up a business. There are so many families that depend on the activities you do. Even when you're in gainful employment, there are so many reserves you put on the side to create employment for so many other people. So if the central bank came up and capped interest rates, that would be one. I think it would take us back to the 90s when the government liberalized the economy and said prices of everything should be determined by forces of demand and supply. So that is unlikely to happen today. The second question was, when is the increase in paid up capital to 150 billion for commercial banks and 25 billion to credit institutions and 10 billion to microfinance deposit taking institutions like take effect? When Bank of Uganda announced the proposal to increase these requirements, we gave ourselves a time frame of 3 years. But the 3 years will start counting once the instrument comes out. The way it is now, the instrument is not yet out, but once it's approved, then we shall begin the counting. Thank you.
Okay, ladies and gentlemen, I believe we have come to the end of our symposium. Thank you all so much for your questions, both physical and online. Our presentations and speeches will be uploaded onto the Bank of Uganda website for those who are interested. Please, once again, do not forget to fill in your registration and evaluation forms in your folders. We shall pass by and pick them up. Once again, my name is Ralph Akorabirungi. Thank you so much for joining us today. Please have yourself a good rest of the day and a restful public holiday tomorrow. Oh, this is where you clap for me.